right, let's get straight to work. Welcome to Iron Financial. This is the only explainer where we hand you the literal market blueprint so you can forge a much stronger portfolio and cut right through all the daily noise. I'm playing the role of your lead analyst today, and my absolute laser focus is on the structural integrity of your investments. Look, we are going to be talking about the hard numbers, the debt loads, the margins, the undeniable physical realities of the companies you own. We are looking for ironclad data here, and frankly, nothing less. Because when the market gets volatile, and let's be honest, it's incredibly volatile right now, you need to know if your holdings are built on solid bedrock or shifting sand. Today, we are pulling the blueprints on Caterpillar's Q1 2026 earnings release. We are going to aggressively stress test their financials and see if this heavy machinery giant actually has the structural durability to carry your portfolio through a highly dynamic operating environment. Let's dive right in. And I'll be stepping in as the market skeptic. I'm here to represent you, the retail investor who is just constantly bombarded with panic headlines every time you check your feed. Look, before we start pouring the concrete on this massive Caterpillar thesis, we absolutely have to address the macroeconomic elephant in the room. We are seeing cracks everywhere in the broader markets right now. Everyday retail investors are facing serious weakness, there are persistent inflation whispers that just won't go away, and there are very real cyclical fears. Everyone seems terrified of an impending industrial slowdown. So I have to ask the hard question, is this panic just media hype, or is the foundation actually crumbling? Is Caterpillar really the heavy-duty foundation a portfolio needs right now, or are we just blindly buying at the absolute top of a cyclical hype cycle? Because we need absolute clarity before we commit a single dollar of capital. You know, it's a completely fair question. When the economic weather gets rough out there, you simply do not want a portfolio made of cheap drywall. You need heavy machinery, you need steel. Caterpillar's Q1 2026 earnings report just dropped, and let me tell you, it is a massive data dump that directly answers exactly what you're asking. We aren't going to look at feelings today. We are going to measure the cold, hard tonnage of their actual financial results. We are going to drill down into the top-line revenue, the segment operating profits, and the underlying end-user demand to see if CAT is truly the impenetrable foundation it claims to be. Let me hit you with the absolute first piece of structural steel we pulled from this report. $63 billion. That is Caterpillar's record backlog level reported for the first quarter of 2026. Wait a second, 63 billion? Are you sure that's not a typo in the press release? I promise you it's no typo. That figure is up an astonishing 79% year over year. You want to talk about a shock absorber against market weakness? A $63 billion backlog literally means the customers have already placed the orders. They have physically signed the contracts. They are waiting in line for this machinery right now. As CEO Joe Creed stated right there in the earnings release, this record backlog provides a remarkably strong foundation for continued positive momentum. When I am evaluating a company's durability, I don't just look at the equipment they sold yesterday, I look at the guaranteed, locked-in work that is lined up for tomorrow. A 79% increase in backlog is a massive show of force in any economic environment. It demands your respect. It tells us that the global demand for moving dirt, mining resources, and building critical infrastructure is not just surviving the current macro headwinds, it is accelerating at a truly staggering pace. Now let's transition over to what they actually managed to push out the factory doors during the quarter. Top-line revenue for Q1 2026 came in at a massive $17.4 billion. Okay, $17.4 billion is undeniably a massive number. But in this specific market, context is literally everything. What was it last year? Because if inflation is running hot, top-line revenue numbers can be incredibly deceiving. That is an excellent point to bring up. Last year, in Q1 2025, they delivered $14.2 billion. That means we are looking at a 22% increase in total sales and revenues in a single year. Think about that for a second. We are not talking about some nimble little software startup scaling its user base here. We are talking about a legacy heavy industrial manufacturer physically adding over $3.1 billion to their top line in just 12 months. This brings us right into the drill down phase of our explainer. A 22% increase is phenomenally aggressive growth for a company of this sheer mass and scale. But top line beats are only part of the blueprint. We really need to know if this revenue growth is structurally sound or if it's just an inflation mirage hiding underlying weakness. Let's pull up the blueprints and see exactly how this dirt was moved. This consolidated sales waterfall is exactly how we visually dissect a $3.166 billion revenue increase. Starting from our foundation of $14.249 billion from Q1 2025, we steadily build up to our brand new high watermark of $17.415 billion for Q1 2026. And I am not going to just summarize this raw data for you. We are going to inspect every single brick in this wall together. Notice that very first massive block representing sales volume. That component alone added $2.318 billion to the top line. That means actual physical volume increases, literally more machines rolling off the assembly line, drove the vast majority of this massive revenue spike. Right next to it, price realization added 426 million. Let me just translate that for the everyday retail investor tuning in. Price realization simply means Caterpillar raised their prices on the equipment and the market just absorbed it without walking away. Exactly right. It perfectly demonstrates incredible pricing power. Customers are clearly willing to pay a premium for the yellow iron, even in a tough economy. We also note a favorable currency impact of 351 million and an extra 71 million from financial products. But the core structural story here, the thing you really need to take away, is that volume, actual iron being assembled and sold, is the primary engine driving this 22% growth, not just accounting tricks or inflation markups. Hold on a second. Let me jump in here. Put the hard hat down for just a minute. I am looking at the fine print on that volume increase. The source text explicitly states that this higher sales volume was mainly driven by the impact from changes in dealer inventories and higher sales of equipment to end users. And then, right after that, it drops this massive caveat. Dealer inventory increased more during the first quarter of 2026 than during the first quarter of 2025. So here's my highly skeptical question. Are actual end users buying these machines to build things? Or is Caterpillar simply stuffing the dealer channel? Because if dealers are just parking yellow iron on their lots to artificially build inventory and hit corporate quotas, that 2.3 billion volume spike is nothing but a temporary sugar rush. It's not a permanent structural upgrade to the business. We need absolute, undeniable proof that the end users, the contractors, the miners, the builders are actually taking delivery of this equipment right now and putting it to work in the dirt. The source data actually has a retail sales table that directly answers that exact concern. Let's look at the breakdown, because this systematically dismantles the whole channel stuffing argument. Overall, total combined retail sales were up 14% in the first quarter of 2026 compared to Q1 2025. That 14% represents actual equipment leaving the dealer lots, getting financed, and going out to the active job sites. But look at the intense heavy lifting happening specifically in the power and energy segment. Power generation retail sales literally exploded by an incredible 48% year over year. Oil and gas retail sales were up a very solid 16%. Industrial was up 3%. Wow. A 48% jump in power generation is just staggering. That tells me the energy infrastructure sector is currently in a massive multi-year build-out phase. Data centers, grid modernization, backup power, they are all consuming heavy equipment at a blistering pace right now. Precisely. So yes, dealer inventory absolutely built up, but retail sales to the actual end users were simultaneously ripping higher at 14%. The channel isn't being stuffed with idle machines, it's being rapidly replenished to try and keep up with intense, real-world, ground-level demand. Now that we've totally secured the structural integrity of the top line, let's transition down to margins and overall profitability. Moving to the consolidated operating profit breakdown, Q1 2026 operating profit came in at $3.085 billion. That is a very solid 20% increase from the $2.579 billion we saw in Q1 2025. Observe the distinct additions to the bottom line here. That massive volume increase we were just discussing, the leverage on that is absolutely fantastic. It translated to a $940 million pure profit benefit. Favorable price realization dropped another $426 million directly onto the operating profit. When you can increase your volume and increase your price simultaneously, you are forging an incredibly highly profitable quarter. Okay, so they are selling more equipment and they are making more money per individual unit. That sounds like a flawless financial blueprint. But wait a minute. I see a massive red block cutting right into this breakdown. We absolutely need to talk about what is eating into these profits, because if you actually calculate it out, a 20% profit increase on a 22% revenue increase means the actual profit margins compressed slightly. The foundation is settling a bit here. Right here. This is exactly the crack in the armor I've been looking for. Look at that brutal $710 million hit from unfavorable manufacturing costs. That is a massive bleed on the bottom line. And SG&A and R&D expenses were also higher by $225 million. What exactly is going on here behind the scenes? As an objective analyst, I have to report the blueprints exactly as they are drawn, and I admit there are definitely some stress factors here. The data plainly states that these unfavorable manufacturing costs of $710 million largely reflect the very real impact of higher tariff costs. Tariffs implemented since the beginning of 2025 are biting really hard into the raw material and supply chain structure. Because of these external friction costs, the adjusted operating profit margin actually slipped from 18.3% in Q1 2025 down to 18.0% in Q1 2026. Now, the company is actively outrunning these costs with sheer volume and their impressive pricing power right now, but that $710 million hit is undeniably a heavy burden on the financial structure. It's just a real-world cost of doing business in a highly complex global trade environment today. So, we've looked extensively at the macro corporate level. Now it's time to pivot over to segment performance to see where the actual dirt is being moved. We are going to shine a massive spotlight on Caterpillar's absolute flagship division, Construction Industries. This is exactly what retail investors think of when they hear the name Caterpillar. If this specific segment is weak, the entire company's foundation is questionable. Let's see the raw numbers. Here is the rapid-fire breakdown of the construction industry segment, and honestly, it is an absolute powerhouse. Q1 2026 sales jumped to $7.161 billion. That is up from $5.184 billion a year ago. That is a jaw-dropping 38% increase in sales, driven primarily by $1.5 billion in pure volume growth and $356 million in favorable price realization. But here's the real flex of their operational leverage: segment profit. It literally surged from $1.024 billion to $1.535 billion. That is a 50% increase in profit. And just look at the margin expansion there. Segment profit margin expanded from 19.8% to 21.4%. This is absolutely crucial to emphasize, a 1.6-point improvement in margin. Despite those heavy tariff headwinds hitting the consolidated corporate numbers we just reviewed, the Construction Industries division specifically is operating with incredible efficiency right now. They aren't just selling more equipment, they are making a significantly higher percentage of profit on every single loader that leaves the factory floor. They are forging higher profitability through immense operational discipline. Okay, the sales and operational margins are phenomenal, I'll give you that. But let's shift focus over to Cat Financial. I'm metaphorically tapping the foundation right now with a hammer, because selling heavy machinery is a great business, but are the customers actually paying for it? Cat Financial is the internal financing arm of the entire operation. To me, this is the true canary in the coal mine for the global industrial economy. If end users start defaulting on their loans, if past dues start to violently spike, it means the contractors and mining companies are literally running out of cash. If the financing foundation cracks, the whole $17.4 billion blueprint fails. We have to thoroughly inspect the credit health before we issue a final verdict today. Let's look at the financial health check directly from the Exhibit 99 release. For the bulls, Cat Financial reported revenues of $947 million, which is a very solid 10% jump. Retail new business volume was $3.19 billion, up 8%. But the absolute most critical structural metric is this. Past dues at Cat Financial actually dropped to 1.39%, down from 1.58% a year ago. Customers are paying their bills faster and far more reliably. But look at the imbalance we're weighing here. Write-offs, net of recoveries, ticked up to $29 million for the quarter compared to $20 million last year. That is a 45% increase in bad debt being written completely off the books, and their allowance for credit losses is sitting virtually stagnant at $283 million. Are they genuinely adequately prepared for a real downturn? It's a slight tick up in write-offs, yes, but you really have to look at the scale of what we're talking about. That $29 million is practically a rounding error against a massive $38.1 billion total asset base at Cat Financial. The notable drop in overall past dues strongly indicates that the foundational customer base remains deeply solvent, highly liquid, and actively working on fully funded projects. Now let's land a truly heavy blow for the bulls. $5.7 billion, that is the exact amount of cold hard cash Caterpillar deployed directly to their shareholders in the first quarter of 2026 alone. They utilized their massive cash flow to repurchase $5.0 billion of Caterpillar common stock and paid out $0.7 billion in dividends. $5 billion in stock buybacks in a single quarter? That is incredibly aggressive capital allocation. It is the ultimate sign of structural durability and extreme management confidence. You simply do not buy back $5 billion in your own stock if you think your underlying markets are collapsing or if you feel your foundation is shaky. Furthermore, enterprise operating cash flow was a highly robust $1.9 billion for the quarter. They are generating massive amounts of free cash, and they are aggressively using it to fortify shareholder value and systematically reduce the share count. We are moving into the verdict. It's time to synthesize all this granular data we've covered. Is Caterpillar a genuine opportunity to forge a stronger portfolio right now, or is it a classic cyclical value trap? The pros are undeniably heavy. We have a monumental $63 billion record backlog and 22% top-line revenue growth reaching $17.4 billion. They're moving serious iron. And the structural durability is unequivocally proven by that $5.7 billion in capital forcefully returned to shareholders in just a single quarter. But the cons are very real, and you absolutely cannot ignore them when building your portfolio. That $710 million margin hit from higher tariffs is a massive external friction cost that management cannot easily control or instantly mitigate. And despite the strong end-user retail sales we saw, there is still a heavy reliance on that dealer inventory build to really juice the current volume numbers. The balance sheet looks incredibly solid today, for sure. But remember, cyclical peaks always look absolutely perfect right before the industrial demand rapidly cools off. That brings us to our final, uncompromising question for you, the retail investor at home. The blueprint is fully laid out on the table. You've seen the sheer tonnage of the revenue growth, the massive cash returns, and you've also seen the very real stress fractures caused by rising manufacturing costs and tariffs. The data is perfectly clear, but the ultimate capital allocation decision is yours. Are these financial results the ironclad investment you need to fortify your portfolio against market weakness? Or is this massive build-out the very top of a cyclical trap just waiting to catch unsuspecting retail capital? Is that $63 billion backlog thick enough armor to shield your investments from the tariff cracks? Dig into your own portfolio, deeply stress test your own personal risk tolerance, and decide right now if you want this heavy machinery doing the heavy lifting for your wealth. Thanks for tuning in to this Iron Financial Explainer. Keep forging ahead, and we will definitely see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.